What growth investors get wrong with cover call ETFs? That is the subject matter that we are going to be discussing in this interview. Today, I'm joined with once again Karl Cheong, Executive Vice President and Head of ETFs over at Ninepoint Partners. So, once again, Karl, thank you for coming onto the channel to speak on a subject matter that maybe others might be shy and quick to avoid, but that's not what we do on this channel.
I'm happy to join you again, Jordan. It's nice to see your audience and happy to dig into a lot of these interesting topics you came up with.
Yeah, absolutely. And there's certainly a lot we're going to get to on this. And we want to clear up some misnomers around NAV erosion and rock, taxes, liquidity in the market. There's a lot of great stuff we're going to get to. Like, how do you deal with investing in cover calls in a bear market? So, a lot of great subject matter that we're going to get to in this video. Now, I also want to lead with the fact that over the last few months, as specifically in a lot of the conversations I'm having with others, whether I see it on social media, the comment section of my videos, others I've talked to, video calls, whatever it might be, the one thing keeps coming up is questions around growth investors are attacking me on something related to cover call ETFs. So there seems to be this heightened, whether you want to call it an attack or you want to call it just they're trying to point out what cover call ETF investors are getting wrong. Well, in this video, we're going to be pointing out what growth investors get wrong with cover call ETFs. So thanks for coming on, Karl, and let's get right to it. For the very first question, some growth investors say you can't get growth from cover call ETFs. How true is this? And if you can't get growth, what strategies does Ninepoint build into their lineup of ETFs to have the best chance at capturing growth?
Well, people often say covered calls can't grow, but that's really not true. You and I both know that. Yes, you can trade a bit of the upside for monthly income, but these ETFs still participate when the underlying stocks move higher. And we've seen this in real time. A big driver of that is the long-term growth is actually the distributions. When you reinvest that monthly cash flow, whether it be into the same product or different products, it compounds and becomes a meaningful part of the total return. They won't leave in a runaway market. Let's just make that clear. But that's the trade-off. You can still get steady, smoother long-term growth with these type of products. At Ninepoint, what you mentioned as an example, we design our ETFs so it's a balance in mind. We typically write up to 50% in covered calls. So the overwrite is about half the portfolio, or we're allowed to, which means the other half, the 50% of the stock exposure, remains fully exposed to the upside. And we do also use modest leverage. We'll get into that in a few examples, up to 25%. That helps enhance the exposure while managing risk. So together, we're giving passive income investors a better chance to capture the growth and then earn attractive monthly income.
Yeah, that's actually a really good point. I see this a lot from the growth investor side of things in the critique of cover call ETFs is this constant barrage of cover calls cap upside, cap upside, cap upside. I see this a lot. But basically, what you're saying is, at least with, say, the 9 point approach with your lineup of ETFs, is that there is this built in hybrid strategy already, which is what you had just mentioned, right? The capped upside portion is on half the portfolio where the other half is unbound and can participate without anything dragging basically without any kind of drag on that performance.
100% accurate. So you get exposure to that stock 1-to-1 up to 50%. And that's assuming you're writing up to 50% as well. So you're participating that way, but you also have the modest leverage that boosts. Let's just remind your community is that it does work. It's a dual-edged sword. It does work on both sides. It can boost the return on the upside as well as on the downside as well. So you have those two components that are really balancing each other off.
Now, Carl, maybe just for the audience that might be curious, they're saying that they're probably hearing us talk a lot about, well, if you write on 50%, maybe they're actually curious about how much does Nine Point write on the high shares lineup usually? Is there a range that maybe you can just touch on?
I can't answer that specifically, but here's what I can say. When you take a look at practices in the industry, I've seen them write on like up to 50%, some up to 100%. So that's less common. But what I can say is that there is a range, usually about 30 to 45% that you see in general a practice that they're writing on. Part of it is that they just don't want to reach that threshold of up to past 50% in case market fluctuations take them that way, and they're breaching like their guidelines and investor policy statements.
Yeah, I actually think that's probably a smart move. Actually, is just like there's like you had mentioned there, a built-in cushion. Maybe volatility just gets just lowers, and as we know, premiums are are predicated on volatility and that and for the right level. But if volatility lowers, at least you can maybe write a little bit more just to sustain that if you have a stable distribution in as an example, you could maybe write a little bit more just to maintain that stable distribution.
100%. It gives the flexibility should the stock fall, should it accelerate, that you can write on different levels of the portfolio. And that comes to the active management point. And we'll get into that. That's how the fund manager earns its fees.
Okay, Carl, for our next question, another common critique of growth investors is that during a bear market, cover call ETFs will not have the ability to recover to prior levels. Can you first explain what benefits might be to holding cover call ETFs during a bear market and how they might recover?
That's a common critique by the growth investors, is that covered call ETFs can't recover after a bear market. I've seen it on various chat boards. But in reality, there is a few built-in mechanics that can actually help during downturns and in the recovery phase. First, during a bear market, of course, the option premiums act like a natural buffer. They don't eliminate the losses completely, as we all know, but they can soften the decline compared to just holding the underlying stock outright. And because you're collecting that income on the way down, the ETF often has less ground to make up on the way back up. Hopefully that makes sense intuitively. In traditional, like non-levered covered call structures, these monthly premiums can partially offset the drop and can give the fund a smaller starting point to really recover from at that point. In structures with modest leverage, like the Ninepoint high share suite, we write fewer calls, but the mechanics change. The leverage magnifies both declines and rebounds. And writing less than 100%, like the 50% that we talked about, means the portfolio still fully participates on the upside on the way up, at least 50% of that plus the leverage. So yes, covered calls, they can recover as a bottom line statement. They just recover differently depending on the coverage levels, the leverage being implemented, and the overall market conditions.
And I think another good point too is just on when it comes to recovery of these kinds of funds, because once again, as you had just mentioned, in the community, there's a lot of chatter from the growth end of things that once these things lose value, they're never coming back. And that is just not true. It really comes down to investors understanding and educating themselves on the structures of the funds and how these things are built. High shares, as we had just mentioned, writes on 50% of the portfolio. There's other funds that go up to 100%
Right.
on the portfolio, which means for investors that are interested in income-based ETFs that do a right level of 100%, that basically means that the vast majority of your total return is going to come on the income spectrum, which means there's not going to be a lot of there's not going to be high participation on the price end of things. So I understand maybe where the critique of cover call ETFs come from on the growth end, but it's usually where the misunderstanding, I think, Carl, is that what they really are pointing to are those kinds of products.
Mm-hmm.
100% coverage, aggressive, total return wrapped up all in the income. However, when we get that right level down, as we had just mentioned, that's where you can better participate, and your total return has more of a closer equilibrium between income and price participation. But it's an income product, so naturally you're in for the income. So more of it ideally will come through the income, but it's a little bit closer. And I think even as I've experienced throughout 2022 and the Trump tariff shock and right so for myself as I'm investing 100% in covered call ETFs, I can at least anecdotally describe that I've seen my portfolio be able to regain whatever ground was lost to hit all-time highs that we've seen. But that's just on a personal end of things. And once again, that it really just comes down to understanding the structure of of the funds themselves.
And that's going to be critical, the override percentage, as well as even on the option writing itself. Ask yourself how much the fund manager is writing out of the money or in the
Yes.
money. That will also determine some of the upside potential.
Right. So we've just described the fact that yes, they can recover, but it's based on structure, right level, moneyness, and just understanding not all covered call ETFs are created equal. So again, investors, it's just really critical to understand the structure of these funds. Now, Carl, for our next question, growth investors often point to the fact that covered call ETFs are not tax efficient. Are you able to provide examples of how they are tax efficient?
In Canada, covered call ETFs, there's the Canadian listed covered call ETFs, can actually be very tax efficient, especially in a taxable account, a non-registered account, more often than investors expect, and certainly more than what the growth investors on these chat boards are talking about. So here's why. First, it's the option premiums. In Canada, these are generally taxed as capital gains, as we know, not interest income. So that means only 50% is taxable. Really important. Second is the Canadian dividends. For the Ninepoint high shares, we invest in Canadian dividend companies. It changes if you're investing in US stocks. We'll get into that later. But when the underlying holdings are Canadian equities, you get the dividend tax credit, also very beneficial. This is significantly more tax efficient than foreign dividends that you get on US or international stocks or interest that are fully taxed. And then third is the return of capital. This is a controversial topic, but we're going to dive into it. This isn't taxed when you receive it. It simply lowers your ACB, your adjusted cost basis, and defers until you realize that gain, maybe in the future when your tax rate is lower. So let's put that together there, that you have a good mix of capital gains, eligible dividends, and tax deferred ROC. While I think of course, where all our situations are very different, but just broadly speaking, these funds tend to be a lot more tax efficient than the common perception suggests. And I think through your experience, Jordan, you can attest that, especially with your tracker that goes over all these type of distribution mechanics.
Thanks for the plug.
Yeah, I subscribe myself actually, so it's great.
Thank you. For our next question, Carl, NAV erosion is another topic growth investors like to point to as a reason to stay away from cover call ETFs. Can you explain what NAV erosion is and how investors can identify NAV erosion from other funds in their research?
NAV erosion really gets talked about a lot, but often I'd say in the wrong way. I think the content creators like yourself are doing a really good service to the end investors, talking about this in various webinar and videos. From my perspective, for income focused investors, it's completely normal for the NAV to drift lower over time because the fund is paying out cash every month. It's not realizing income every month in the dividends, for example, but it is paying out every month. So this isn't a failure. That's my take, and from a ETF provider perspective, that's just how income products have historically worked. NAV erosion only becomes a real issue when the fund consistently pays out more than it earns in total return.
Mm.
Total return, I've heard Adriano talk about this as well, is kind of the be all and end all. The proper way to evaluate this is looking at the total return chart. Total return is rising, the strategy is working. If total return is flat or declining, the distribution might be too high. And I think that's buyer beware at that point. There is a big difference between capital erosion, NAV drifting because you're paying income, and total return erosion, a portfolio failing to generate the total return that tells that real story that we're all looking for as end investors.
I think so, and that was a really good point. I really like that distinction you're making as sort of uh, just an additional explanation mentioning capital erosion. And so I think this is where growth investors that I've seen kind of get this wrong. Let's talk about that, the strategies that we talked about maybe at the top of the interview, where a strategy is writing 100% on the entire portfolio and not leaving really any room for the for any kind of price appreciation at all. So I think we're growth investors. I think they're maybe getting a little bit distracted by the fact that it has more to do with, as you just mentioned, capital erosion. It's just the price. We're not factoring in all the distributions, which, as for an income investor, most of your total return is wrapped up in income. Again, I'll mention the fact that that level will change based on strategy, but I think there's too much of a focus on the fact that okay, it's really just it has to do with really capital erosion, and then that explodes to encompass all funds. But once again, we have seen the fact that NAV retention is, at least here in Canada, seems to be doing way better when that right level is just lower. So whether it's a half hybrid strategy, it seems like many of the fund managers kind of
Mm-hmm.
adopt more of this way of going about producing products for income investors. So, anyways, investors, that's just again something to think about when it comes to NAV erosion. Is that just because you see the price declining without factoring in dividends, that might be a little bit of a misnomer. So always consider the total return as well, and of course that the structure of that fund. For our next question, some growth investors identify low volume as yet another reason to not get into these funds. Should investors worry about liquidity when they go to push the buy or sell button if the volume is low?
So I've heard this issue over the years I've been in this industry. And if anything, hopefully you take this away. If you don't take anything else away, one is volume does not equal liquidity. An ETF could show low volume on the screens you pull up on a daily basis, and still be very highly liquid. Liquidity comes from the underlying stocks, not from how many ETFs are trading on screen that day. If an ETF holds large liquid names, take for example Nvidia in the US, market makers can create units on demand that keep spreads one tight and then offer a enormous amount of liquidity to you at any given point.
Okay, so basically what I'm hearing is that I think it's blown out of proportion, right? It's like stocks have, like, if you're going to worry about liquidity and volume, it has more to do with stocks than it does an ETF. An ETF is just a vehicle. It's just holding underlying. It's based on the underlying volume of those said stocks within the basket, as you had just mentioned. If it's an ETF with large cap stuff inside of it, then it doesn't sound like that's really a concern at all.
100% accurate.
Okay.
That's the way to think about it.
Sounds good. For our next question, Carl, some bigger names in the influencer world might say that cover call ETFs do not produce real income. This might come across as confusing for those invested or thinking of investing in covered call ETFs for the stable cash flow. Can you clear up any confusion on the topic?
The income is very, very real. When we sell call options at the ETF provider level, we collect actual cash premiums from the market. It's like renting out a portion of the stock's upside
Hmm.
as long as we keep writing options. Those premiums flow into the fund and support the payout that we're paying on a monthly or biweekly basis. The distribution tends to be in a mix, as I mentioned there, with the option premiums, dividends that the companies are paying, most likely on a quarterly basis, if they pay dividends. And for example, bank stocks or utilities, low volatility stocks tend to pay dividends. And sometimes return of capital, as we've talked about, to smooth out. So those are all cash flows. But the option premium itself is a genuine recurring income source that is very, very real.
Yeah, exactly. So it's anyway, it's very funny to me. It's like it is what you just described it to be. Like that to me sounds like income, and I'm sure for many other investors on the other side of this would agree as well. For our next question, Carl, growth investors sometimes talk about the fact that only the fund managers are winning by selling these products. Can you speak at all about costs of running an ETF, competition, and what are you hearing from investors that invest in the high shares lineup regarding fees?
Well, fees is certainly top of mind. We've priced our ETFs at we've waived the fee for the first 6 months, as you know, up until the end of February, and then priced it at 29 basis points to management fees. But it is a fair concern. Covered call ETFs involve a lot more than just the passive index, the S&P 500, or just tracking the S&P TSX. Behind the scenes, you're managing expiries of the options, as we talked about the moneyness of the option. We're monitoring the volatility in the marketplace and in the option marketplace. We're rolling positions of these option contracts, whether it's going to be on a weekly or monthly basis, or even further out, you're looking to capitalize on different opportunities there. And you're doing this across oftentimes multiple holdings in a basket, for example, every single week or month. Lots of work. To replicate this yourself, you'll need significant capital. I don't know if you've ever tried to get options approval on your online discount channel. It might be easier now, but I know I went through that process, very difficult. And you'll face higher transaction costs as a retail investor relative to an institution like Ninepoint that manages over $7 billion. That management fee, that 29 basis points that we'll start charging at the beginning of March, covers the entire professional execution of experienced portfolio managers. And more importantly, the returns are always shown after fees. So when you're pulling it up on your screens, investors can see the real net result after fees and borrowing costs that you can get from the actual turn. Most investors tell us that they value the consistency and the time savings far more than that 29 basis points that we're charging. And that's why we've seen high shares grow quite consistently since we've launched.
And I think one thing that also Ninepoint is doing is also right, especially with coming into this space with the high shares lineup. And again, you guys, we can't say it enough, but you've waived that fee until February, well, or I guess until March,
March.
tail end of February. The fact that these products seem to across the board seem to be coming down, and then Ninepoint comes in, and then right, and then just lowers it and even more. So something that looked very expensive, maybe to that maybe most investors would think about. If they're thinking of a passive index, something that's 0.008 basis point, basically it's free at that point, versus active management that was maybe on average a couple years ago maybe 60 to 70 basis points, but now that's basically cut. So basically Ninepoint's come around, and just to think of it that the industry has come to a point where it's basically half of that just a couple years later. So Um, So, like to me, hearing the fact that, especially with all my conversations with people like yourself and others in the professional income space, it just sounds to me like there's obviously a lot going on under the hood. There's more going on under the hood than I would care to do myself. And so that's why it's also critical to have conversations like these so we can bridge the gap between the people who are managing these funds versus the retail and who maybe are thinking about doing it themselves. And I know some do. And I was at that Blossom an investment event in Toronto back in September, and I had a couple of people come up to me and share how they are using funds like Ninepoint and others, and but also writing their own strategies as well. And for me personally, it was interesting to hear all that, but it just sounds like a lot of work. So at least with a fee like that, it just sounds like investors are getting good value, and then they can just worry about the golf course and not necessarily the mechanics of how their investments are, how they themselves are going to be executing it.
That's the beauty of competition. We came in as the third provider on the single stock space, and we wanted to make a splash, if you will, and that benefits the end investor. And as more competitors come in, that's the beauty. You get beauty of choice brings down that cost.
In my opinion, it is only the fund managers winning when it comes to creating these products and selling them to people like, say, myself and other investors. In my personal experience, I feel like I'm winning. I really enjoy investing in these products and also sharing my knowledge on these products as well. And so, as far as I'm concerned, you guys are winning. The end investors with the hundreds and hundreds that I've talked to, it sounds like they're winning as well. People really enjoy investing in these products. Karl, I got one final question for you. In your opinion, what is the biggest misconception you get lighting up your inbox or at these events from investors in regards to cover call ETFs? And do you see these misconceptions magnified at all from the growth investor types?
I got two for you. So the biggest misconception is that yield equals the expected total return. Flashy yields do not equal the total returns of these products. A high yield doesn't mean the ETF will deliver that number in performance. Really critical. Yield is simply cash paid out. Total return is income, as we talked about, plus the price movement. We intentionally trade some of that upside for the steady cash flow investors are receiving on a monthly basis. On another misunderstanding, the second one is that these covered call products are only for retirees only because of the income component, of course. Not true, as we proved it with today. We see growth investors also using them. You're an example, Jordan. You're only in your 30s, so you're looking for growth as well. You're using them as a cash flow engine to fund other purchases, whether lifestyle purchases or other products,
Mhm.
or I would say you're possibly using it as a stabilizer for potentially volatile portfolios you have in other accounts. The strategy is very versatile, very multifaceted, and it's not a one size fit all. So I hopefully that's the takeaway.
No, I actually really like that last point as I think most investors who follow my channel, they know I'm 35, I'm going on 36 in December, and even though we're talking, or at least the subject matter is, again, what growth investors get wrong about cover call ETFs, that doesn't mean I don't care about growth, or that doesn't mean you don't care about growth, or Ninepoint doesn't care about growth. It simply means that, again, there's a type of investor that's knocking on these funds, but that doesn't mean even though I'm into income, I don't care about growth. I actually do care about it, but I care about it in an income product. So for me personally, having this hybrid approach is like the best of both worlds. I still get some of that upside participation. I still can generate income. I can reinvest that if I want, and I can take that money out whenever I want, and to fund the lifestyle that I think as I see fit, basically. So to me, it's the best of both worlds. I can turn it into a growth strategy, and for most of my and for most of my investment experience, I've been using income products in this fashion, reinvesting 100% of it. And treating it mostly like a growth strategy of sorts, but that is the flexible power of cover call ETFs. You can turn the drip on and reinvest, turn it off, take the income, maybe for a season or forever, who knows? And maybe you still get some of that upside participation. Once again, it all just depends on the structure of the fund. So, want to remind investors about that once again.
Great points, and great that you've had that experience so far, and you're sharing that with the community.
Yeah, absolutely. So, once again, Karl, thank you for coming on to the channel once again. Look forward to more conversations from you and basically the Ninepoint products as well. So, thank you once again for coming on, Karl.
Thanks, Jordan. Actually, I just want to mention one thing. Just building on our first interview and some of the comments that we got. This is back in August, I believe, when we first spoke. Building on the comments, we're going to be hosting a 9 Point investor call. This came directly from your community. We're going to be hosting in early December. Details to follow. With my co-CEO, John Wilson, we'll walk through the 2026 market outlook from our perspective at 9 Point and clear up again some of the biggest myths around covered call ETFs, some education on that front as well. So we're going to open up to investors, and we'll share those details shortly, hopefully via Jordan and other sources, and hopefully everyone can join.
Absolutely. So, once again, Karl, thank you for coming on to the channel. Really appreciate your insights and coming on to just help investors get more educated on cover call ETFs. So, once again, thank you for coming on again.
Thank you, Jordan. Thanks, everyone.